Greece has been all the talk when it comes to global economics. An uncertain future and a collapsing economic infrastructure has broad implications for Europe and much of the world. But that pales in comparison to what is happening in China right now. A total meltdown with half of China's companies, I've read everywhere from a third to a half, suspending trading as the market experiences a crash of epic proportions. Now, this will be huge, not only for surrounding and other global markets, but for the United States, which has a sizable portion of its debt owned by the People's Republic of China. It's complicated stuff, so we've brought in an expert to help digest it. Joining me now is Dan Mitchell, a senior fellow at the Cato Institute. Dan, welcome to the show. It's good to see you. I've heard that this has been characterized as being similar to the 1929 market crash. Is that hyperbole, or is that pretty accurate?
We've certainly had a big drop in the Chinese market, but then again, it went up by 100% in 1 year. So almost certainly everyone should have been expecting a bubble. The bubble appears to be in the process of bursting. The real question is, what's the fallout? What's going to happen next? Will this lead to a recession in China? Will this have echo effects on economies such as Australia that trade heavily with China? Does this mean that China might start doing things geopolitically that we don't like? Who knows?
Well, what gets me is that, because I went back and I was looking even far back as 2012, and I've seen everyone from The Economist to Forbes, Wall Street Journal, everyone was predicting that China was going to have a crash in 2015. Now, you would think with its sizable economy, and as you were saying, just the way that it trades with Australia and the amount of trading that, and the amount, well, the debt that is owned by China, ours anyway, you would think that that would garner more headlines than what we see happening in Greece. Is it just because of the EU? Is that what makes that story more sexier as opposed to what's happening in China? Because the fact that this is only now becoming the big story that it is a little unnerving.
I can understand why people are focusing on Greece, because it is sort of the leading edge of a wave of collapsing welfare states, and we have some of those same long-run issues in terms of demographics, aging population, and as well as poorly designed entitlement programs. So I don't blame people for focusing some on Greece, but China is the world's second biggest economy, and to have a big collapse of a stock market bubble, which follows, of course, the property bubble that collapsed there, we should, if nothing else, we should be learning that a country cannot consume in the long run more than it produces. And so Chinese politicians, I think, were mistaken in thinking that propping up bubbles was a good policy. And of course, we should learn that, because we have politicians, trying to resuscitate Fannie Mae and Freddie Mac and do the same thing in the U.S.
We'd heard that their middle class was growing. I anticipate that that's not going to be the case anymore after this, especially because, from what I understand, a lot of it, you mentioned credit, you mentioned some of the, some of the investments were called into question, but also, how much did the media or the state-owned media in China play into this? Because there was some talk that, perhaps that misled some individuals. What is your take on that?
I have no idea whether some of the retail investors were just being greedy and got in at the end of a bubble, when, of course, it's always good to get in at the start of a bubble. Maybe the Chinese government was promoting it. It's clear the Chinese government has been promoting bubbles in general. They had their big Keynesian splurge where they built these empty cities. Yeah. They promoted the housing bubble and now the stock market bubble. And here's the thing to understand. China did do a lot of economic liberalization beginning back in 1978, and they opened up their economy to world trade, but it is still a heavily state-controlled economy. In the Economic Freedom of the World Index, they're only 115, ranked 115 out of 152. So it's far from a free market. It's still a relatively poor place, according to the World Bank. Their per capita GDP is under 8,000. Ours is more than 54,000. So they're just a tiny fraction of the U.S. So all these people for years have been saying, oh, China's going gangbusters. They're the economy of the future. It's still a very poor place with still a lot, far too much government control. And I think we're seeing in this stock market bubble and the collapse, we're seeing some of the negative effects of government still having too much control in that economy.
How is this going to affect the United States' market, and particularly all of the people, including myself, Dan, who are wondering, well, what does this mean for the debt that's owned by China? Are they going to come knocking at our door, Dan, and saying, all right, it's time to pay up. We got to correct what's going on over here, and we're going to use you to do it?
Well, they don't really have any leverage over us because, yes, the Chinese government and some other quasi-government institutions own U.S. government debt, but we're paying the interest on that debt. They don't have the right to call that debt and get it paid back overnight, and they probably don't even need to. This is simply a question of, in the private, pseudo-private stock market in China, prices were overvalued. Now prices are coming down, and the people who are owning the stocks are hurt. But in theory, the Chinese government itself may be insulated from that, except to the extent that they intervene and try to prop up the bubble and try to stop market prices from going to their genuine market clearing level. And of course, that's the challenge. How do you determine the market price in an economy where there's still too much central government control of how resources are allocated? And this gets to the fundamental issue of, do you really want a free market economy? If China wants that, they need to give up control. And so far, the central party apparatus in Beijing doesn't want to give up control and do further liberalization.
Last question for you. With unemployment here being what it is, I mean, real unemployment being somewhere about 40% or higher, Greece going through what it's going through, entitlements ruining economy after economy. Is this just the beginning of a domino effect? Is it too early, basically, to tell people start putting money in your mattress?
There's no question in the long run, if we don't do genuine entitlement reform, we're going to face the same challenges that they're facing in Greece, and for that matter, the same problems they're facing in Spain, Italy, France, Belgium, et cetera, et cetera. Aging populations and poorly designed entitlement programs, that is not a good recipe. Historically, when we had a population pyramid with very few old people and lots of young workers and an even bigger generation of children behind them, historically, we could maintain a modest-sized welfare state we'd grow a little bit slower, but we could do it. But with the changing population demographics, fewer children, people living longer, even modest-sized welfare states sooner or later are going to blow up. We have some advance warning. We can see from Greece that if we better make changes if we don't want that same fate. And even if that fate is 20 years down the road or 30 years down the road, we have some advance warning. Let's fix the problems. Let's not make the mistakes of Greece and China and other countries that try to consume more than they produce.
I hope that we can. I hope that we do act in time. Dan Mitchell, Senior Fellow with the Cato Institute. Dan, appreciate you joining us today. Thank you.
Thank you, Dan.